Welcome to the Deep Dive. Today, we're getting straight into a recent quarterly earnings report. We'll boil down the key numbers and what management said, giving you those rapid-fire insights you need.
Exactly. The plan here is a full but, super concise overview. We're focusing on the really important takeaways for you.
Right. Helping you connect the dots, understand the why behind these figures, and see the bigger picture for your own thinking.
Precisely. We want you to get the context, the implications.
Okay, so we'll kick off with just the headline results first. Getting those main financial points and management's initial take.
Right.
Trying to keep it very neutral, objective.
Yeah, no spin, just what was said.
And then after that quick snapshot, we'll dig, quite a bit deeper.
Mm-hmm. We'll unpack the financials that really matter, get into management's thinking, and talk about guidance or any sort of macro stuff they discussed.
Really get under the hood of the strategy.
Hey, that's the idea.
Okay, let's get into it then. Starting with the overall results, Q1 revenues were $5.2 billion.
Right, pretty much in line with what analysts expected.
Yeah, consensus was right there. Earnings per share, $1.85. That was a little better than the $1.82 expected.
That's a light beat, yeah.
But what really jumped out, I think, was while the top line growth was, kind of modest, only 3% year over year, the gross margins expanded. They hit 45.5%, and that's up from 44% just the quarter before.
Yeah, that margin jump is actually quite significant, especially now.
It really is.
Yeah.
What did they say drove that? Any specifics on how they pulled it off, and do they think it'll stick?
Well, yeah, they were pretty clear on that. They highlighted specifically their faster spending on AI for supply chain optimization.
Ah, okay.
And management directly credited that with cutting their cost of goods sold, especially, in their biggest product area.
So it's not just vague efficiency savings, it's tech-driven.
Exactly. They framed it as a real, sustainable strategic edge, not just a temporary thing.
Interesting.
And beyond that, free cash flow looked healthy too. Came in at $750 million for the quarter, which, converting earnings to actual cash like that is always a good sign.
That cash flow number is key.
Yeah.
And when you put it together with how they manage spending, well, it tells a story about capital allocation, doesn't it?
It does. Their operating expenses were kept in check, right? Didn't grow as fast as revenue.
Yeah. Well controlled. R&D spend was up a bit, but they tied that to the next-gen product line.
Right. Investing in the future there.
And the balance sheet looked decent, too. Net debt actually came down 5% from the last quarter.
Mm-hmm. Deleveraging a bit.
But, the question is always, are they being too disciplined? Could they be leaving growth on the table by not spending more, even if management says they're investing enough?
That's always the tension, isn't it? But look, lower debt plus good cash flow. That's not just about paying bills. It's about flexibility. Gives them options.
Okay. Strategic optionality.
Yeah. Management really hammered home their focus on speeding up innovation in the core business. Yeah. But they also mentioned looking at, disciplined M&A in related markets.
Ah, so M&A is potentially on the table.
Potentially, but disciplined was the key word. And importantly, they flagged a strong pipeline of new products coming in the second half of the year.
Okay.
So it suggests the investments are happening, but they're very targeted, aimed for impact soon, rather than just, spending broadly. It feels like balancing today's discipline with tomorrow's strategy.
Right, balancing those two things. Okay, so that's performance and financial health. What about the outlook? Guidance is always critical for investors, especially with all the macro noise. What did they signal there?
Yeah, the guidance definitely showed confidence, I'd say, even with, all the market uncertainty.
How so?
Well, they kept their full year revenue forecast the same, still expecting mid-single digit growth. But interestingly, they nudged up the EPS guidance range slightly.
Okay, and why was that?
They tied it directly back to that better margin profile we talked about. Right. And sticking to their cost controls.
Makes sense. Did they talk about headwinds, supply chains, inflation?
Oh, yeah, they addressed them. Acknowledged ongoing supply chain issues, especially for certain components, but they said their diverse supplier setup helped lessen the blow. No major disruptions reported.
Right.
And on inflation, they went into some detail, actually. Talked about strategic pricing changes, almost product by product, and those operational efficiencies basically offsetting most of the higher input costs. So protecting the bottom line.
So it paints a picture of a company managing through the turbulence pretty well.
I think that's fair. Resilient seems like the right word.
Okay, so tying this all together for you, the listener, the call suggests a company that's navigating a tricky environment pretty effectively.
Yeah, the focus seems less on just chasing growth for growth's sake and more on smart execution, profitability.
Right. And those strategic investments, the new product pipeline, the hint of disciplined M&A, it suggests they do have a longer-term growth plan lined up.
And it prompts you to think, okay, how does this info fit into the wider sector? Are these trends, tech-driven margin growth, careful M&A, supply chain strength, things you should look for elsewhere?
Does it signal something about competitors, perhaps?
Exactly. It gives you more to explore in your own analysis, maybe challenge some assumptions about the space.
Okay, let's shift gears now. It's time for our This Is Not Financial Advice segment. So prepare for something speculative, but hopefully thought-provoking.
Indeed. Let's put on the hedge fund analyst hat for a moment, pitching to the investment committee, right? Here's a wild, but I think plausible idea.
Okay, let's hear it.
Given how they've shown they can boost gross margins using specific operational tweaks, and they've clearly got this new product line coming.
Yeah.
What about a very focused long position?
How focused?
Think about an out-of-the-money call option, maybe expiring, say, 2 quarters out, targeting a price perhaps 15% higher than where the stock is now.
And the rationale?
The bet is that when that new product line hits and gets traction, it could cause a bigger than expected revenue bump, leveraging those existing efficiencies and potentially leading the market to re-rate the stock upwards. It's a levered play on that specific catalyst.
Interesting. Any alternative, maybe more contrarian view?
Well, maybe.
Yeah.
For a really contrarian, high-risk idea, if the market starts to worry that their M&A strategy might become too aggressive or maybe dilutive, which, again, management insisted wouldn't happen,
Right.
you could consider a short position, maybe, in a competitor that's less diversified, maybe has a weaker balance sheet.
A pair trade, essentially.
Kind of. The idea is that if M&A heats up, this company's strong cash position gives it an advantage, potentially squeezing smaller players. The market might punish those perceived weaker competitors. High risk, obviously. And again, these are just hypothetical scenarios, absolutely not financial advice, critical thinking exercises.
Understood. So just to quickly recap the main points from our deep dive today, we saw resilient financials, notable margin expansion driven by operational specifics, strong cash flow.
Yeah, even with just moderate revenue growth.
And management seems focused on discipline, strategic innovation, that new product pipeline is key, and they seem to be managing the macro stuff pretty proactively.
Right. And we hope this encourages you to think about what these insights mean for the whole sector. Operational strength, capital allocation. What signals does this send for your own analysis of other companies?
What does it suggest about the competitive dynamics ahead?
Exactly. Food for thought.
Well, that wraps up our deep dive for today on this earnings call. Thanks so much for tuning in and engaging with this.
Yeah, appreciate your time.
We'd definitely be interested in hearing any thoughts or questions this sparked for you. Until next time.